If you followed the headlines lately, you've seen a steady drumbeat about America's swelling national debt. Interest payments alone now rank among Washington's biggest bills, and new spending promises keep widening the gap between what the government takes in and what it shells out. The United States can muddle through longer than most because it issues the world's reserve currency, but that isn't a magic trick. It's a grace period. At some point, someone pays for debt. Maybe it's workers through higher taxes, everyone through inflation, or future generations through a crisis nobody wants to name out loud. China is often cast as the neat counterweight, disciplined, thrifty, the world's lender rather than its borrower. On paper, its government debt looks smaller as a share of GDP than America's or Japan's, and for years it held a mountain of U.S. treasuries, a subtle reminder during trade spats that Beijing had leverage. But that tidy story unravels once you step off the glossy brochure and look at how Chinese debt is actually arranged. Unlike the U.S., where most borrowing sits cleanly on the federal balance sheet and state and local borrowing as a footnote, China has spread the liability across provinces, cities, financing vehicles, and a universe of state-owned enterprises. The bill is still the bill. It's just hiding in more coat pockets. Start with local governments. Provincial and municipal authorities have enormous incentives to borrow for projects that boost growth targets and careers. The formal numbers already show massive obligations at this level, and they understate the reality because so much borrowing flows through special purpose vehicles designed to stay off the main books. Then there are the state-owned enterprises. Think of companies that look like private firms, construction giants, industrial champions, even banks, but are ultimately controlled by the state and often tasked with policy goals first, profit second. They borrow to build airports, rail lines, industrial parks at home, and prestige projects abroad, and the debt technically sits with the company, not the treasury. The catch is obvious. If things go wrong, the state cannot simply shrug and let the crown jewels implode. Contingent liability has a way of becoming real. That's why, depending on how you tally it, China's broader public sector debt load can be far larger than the headline number suggests, easily surpassing America's as a share of output and, by some cautious estimates, pushing into territory normally associated with financial distress. And that's before you debate the denominator. Independent researchers have long warned that provincial data can be massaged and that China's GDP might be overstated. If true, the real debt burden as a share of output is heavier still. Point is, appearances mislead. One system piles most of its debt on a single ledger. The other scatters it. The weight is comparable, and in some views, China's is heavier. Now here's where the story gets even stranger. In normal markets, more risk means higher yields. The U.S. borrows for 10 years at a few percentage points above inflation. China, rated lower by the big credit agencies, often borrows cheaper on paper. Why would anyone accept a lower return from a perceived riskier borrower? Because in China, the game isn't the same. Capital controls limit the ability of savers and institutions to move money abroad. Banks, many state-owned, channel funds where policy wants them to go. And the alternatives don't sparkle. Chinese equities have lagged badly over the past 2 decades, and listings can be upended by policy shifts overnight. If you're a domestic investor seeking safety, government and quasi-government debt is one of the few chairs left when the music stops. Consumption tells a similar tale. America's economy is dominated by shoppers. China's isn't. Households save aggressively and spend cautiously, which suppresses the inflation that would normally flare when a country creates a lot of money. And China has created a lot of money. Its broad money supply has multiplied at a pace far beyond the U.S. over the past generation. Ordinarily, that would set prices on fire. Instead, with frugal consumers and a manufacturing machine that keeps goods cheap, price pressure has been mild, sometimes too mild. Deflation is not prosperity. It's a signal that demand is timid, investment can stall, and cash looks safer than risk. All that extra saving needed a home, and for years it found one in property. Chinese real estate became the biggest asset class on earth as households poured savings into apartments that often serve more as investment certificates than living spaces. The result is familiar. Housing prices detach from incomes, developers stretch thin, and local governments hooked on land lease revenue. When property wobbles, the tremor runs through family balance sheets, local coffers, and the banks that finance the boom. That's a delicate feedback loop to manage. With subdued consumer inflation and tight financial plumbing, Beijing can borrow cheaply domestically and even manufacture credit through its state banks. That sounds like a cheat code until you map where the money bulges. You don't get consumer price inflation, you get asset price inflation in housing and a mountain of liabilities tucked in semi-public corners. And because so much borrowing happens outside the central budget, interest costs vary wildly. The sovereign can fund at low rates, while provinces, city vehicles, and state firms can pay much more, especially when stress rises. A low national average masks pockets of strain. Is this sustainable? By the conventional yardsticks that say high debt to GDP leads to ugly choices, haircuts, inflation, austerity, China looks precarious. But there's a counterweight you rarely apply to Western governments. Net worth. The Chinese state owns the land and a vast portfolio of enterprises and infrastructure. Some of that can't be sold without chaos, but it does mean liabilities are matched by meaningful assets in a way that the U.S. federal government, loaded with debt and relatively few liquid assets, is not. In principle, Beijing has more levers to pull to shore up its books, from selling stakes to monetizing land rights. In practice, doing so at scale risks kneecapping growth or sparking political backlash. Levers exist. Pulling them is costly. Step back and the deeper lesson isn't about who's better or worse. It's that the two systems are fundamentally different. America's private sector is messy, innovative, sometimes underregulated, and backed by a consumer culture that spends. China's model is top-down, oversteered in places, heavy on investment, light on consumption, and disciplined at keeping inconvenient numbers out of the spotlight. The U.S. wrestles with inflation. China flirts with deflation. The U.S. borrows openly. China borrows diffusely. Each relies on the other more than the rhetoric suggests. A financial divorce wouldn't crown a winner. It would make two losers. So how bad is China's debt problem really? Bad enough to demand attention, nuanced enough to defy easy doomscroll thumbnails. The liabilities are large, the risks are real, and the system that kept inflation in check also inflated an enormous property bubble and piled obligations on entities that don't have sovereign-level footing. But China also commands deep domestic savings, strong state balance sheets, and the institutional power to redirect capital quickly, advantages that can delay or soften the reckoning. Debt isn't just debt everywhere. It's debt woven through very different political and financial fabrics. If there's a takeaway, it's to be skeptical of simple narratives. The borrower and the lender are not who they seem. The scoreboard isn't kept in one column. And the endgame, whenever it comes, will be shaped as much by structure and incentives as by arithmetic. Thanks for watching InvestingFlix, where smart money learns smarter moves. Subscribe for more insights that grow your wealth.